Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, we're going to talk a little bit about the big picture, the macro picture. I have as my guest today my good friend Wayne Kaufman, Chief Market Analyst at Rockwell Securities. Wayne, it's a pleasure to have you.
Always great to be here.
Now, it's been a while. Half the year is now gone. I think it was kind of a surprising year in the sense that we saw kind of this strength in stocks, in equities. We saw negative prints in GDP. A lot of people left scratching their heads. Gold struggling a little bit, although static, I would say, somewhat positive. And some improvement we're seeing in China, copper perking up a little bit. What do you make of all this?
I think it's a slowly improving economy, certainly here in the States. China is doing better, and it has been a surprise. I was not expecting second quarter to be quite as strong for the equities markets. I've been expecting a real strong fourth quarter for the year. Good first quarter, kind of flat, second and third, real strong fourth. But we had this very strong second quarter, and when we have a first half of the year that's this strong, it does foreshadow a strong finish to the year. So I'm expecting the market to remain good. And
particularly curious in light of the fact that the actual economy has been weak. We saw a negative 3% GDP in the first quarter. I don't think anybody expected that. Even the worst forecasts were not coming in with a number that low. And yet stocks continue higher. And even some, I would say, economically sensitive commodities, right? Copper starting to perk up. Again, gold, it hasn't sold off. It's actually holding in quite nicely. Silver going from the $18 level up to 21.
Crude oil.
Crude oil, exactly. That perhaps also tensions in the Middle East. So you say we add on to this strength in the second half of the year. There's momentum here.
Yeah, there's tremendous momentum. There's been a lot of statistics, like a tremendous amount over 40 days in a row where the S&P didn't move greater than 1%.
Very low volatility.
Very low volatility, and that type of thing also forecasts for strength in the future. The number one characteristic of this market, though, to a pure technician, has been the lack of sellers. Anytime we've seen the pullback, it's been because the buyers have gotten a little tired. We haven't seen any type of aggressive selling.
Now, when you say that, how do you measure that? I mean, is that looking at volume? If the market is going down and you see a big increase in volume, then you would label that as new selling, aggressive selling?
The classic way of doing it is exactly what you said. When you do get overbought and you start to pull back, if it's on lighter volume, then you see that there's no aggressive sellers. I keep a couple of other statistics, mostly stocks that are making 4-week closing price lows and 13-week closing price lows, and I do 10-day averages of those, and these are at very, very, very low levels. So there's just no real sellers. And it's not just a United States phenomenon. We're seeing this around the world, that there just aren't sellers around the world. So the concept that if investors around the world globally are not interested in selling, why would all of a sudden it happen here, independent of that? So odds are saying it's not going to happen.
Now, a lot of people are saying, this is just a big bubble, although, they've been saying that for a long time, and it just continues to creep higher. In my opinion, it looks like the classic wall of worry that we're climbing up. But there has to be some things we need to pay attention to. You mentioned oil prices. Now, clearly that could impact the economy. It could impact consumer spending. Is there a level, a threshold that you see either technically or fundamentally where that would throw up a caution flag? $110 a barrel, $120 a barrel, and also gasoline prices, which are rising again.
Yeah. First, let me address your wall of worry, because I think you've got it right on the button. Valuations. Okay, why aren't we seeing sellers? Because on a historical basis, valuations are excellent. I know a lot of people are talking about, price to sales is at high levels, and I look at all that stuff. But the most important thing to me is valuations based on the spread between bond yields and equity yields. And that spread has been going sideways, if you chart it, for a year and a half.
Good point.
So it's in a very, very stable range. So unless we see a big spike up in yields, along with a lack of an increase in aggregate S&P earnings, then we're going to stay in that range. Maybe we level off for a little while. Earnings season is coming here, so that'll tell. So what else am I looking at? And by the way, aggregate earnings estimates are moving up. So they're not even stagnating at this point. They're moving higher.
Valuations get actually better.
They get better, or they'll stay the same,
right,
even if yields move up. But on a historical basis, they're still ultra attractive. And going back to years before the crisis, we could be at 4% on the 10-year note, and we would still be okay on historical valuations. So then what am I looking for? Well, a spike in interest rates on a short-term basis might hurt. We got over resistance at 2.6 on the 10-year note. 2.8 and a fraction is next resistance. A fast spike, that might shake some people up temporarily.
Doesn't seem like that's going to happen, though, because Yellen just recently spoke at an IMF meeting where she did not really give any indication of the Fed anytime soon raising rates. As a matter of fact, she said something that, the Fed was going to focus more on, oversight and regulation to control risk, which I frankly think is a good way to go. And so it doesn't look like it, although we did see a good jobs number recently.
So great jobs number today. We've seen other good economic statistics. But you're right, I don't think it shoots up. The other thing would be a price in the spike of oil. 110 to 113 a barrel. That's a pretty key resistance level. It's possible we do go above it. It's how we go above it. And the fact is, with the United States doing so much of our own energy now, those prices benefit a lot of the companies and a lot of the workers here. So it's a balancing act, and we have to watch for sector rotation.
But we did just approve, the Obama administration just approved exporting our oil for the first time in 40 years. I mean, we hear a lot about energy independence, and yet we want to sell it off? Does that make any sense?
Well, it might, as long as you're not driving up the price too much over here. So it might. That's going to be an interesting thing, because there's a bunch of dynamics there, but the quality of the oil, how it's able to be used by our refiners. Our refiners are now having to retool in order to use a lot of the fracking oil, because some of it has very high content of natural gas in it, and it's catching fire. So they're finding they need to it may be better to be exported.
So now, to sum it up, I guess, and it seems to me, given the complacency that you mentioned and low volatility, which I guess is a reflection of the complacency, and the fact that valuations are good, and the fact that the economy, we had a bad first quarter, but we could come back. China looks like it might be getting a little bit better, some indications there. We could possibly really start to take off in the second half. And don't you think that would include many commodities and materials?
Great point. Commodities and materials, we've just started to see money now flowing into them. Some of the bigger names like Freeport, McMoran, oil, copper and gold, that stock all of a sudden has started to move up. Some of the other ones, they're starting to get, and gold, you mentioned going sideways. I think that's accurate. Gold looks like it wants to trade just in that range, 1,200 to 1,400. Yeah. I think the bottom is in, but it needs to really break 1,400 to give a real bullish signal.
All right, always great perspective. Thank you very much, Wayne.
You're welcome.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.